Hi, my name is Satwan and welcome to today's video where I'll be comparing CBDCs or central bank digital currencies to cryptocurrencies in the context of payments. If you're new to the channel, Digital Money Lab aims to help your business increase sales conversions and cut payment processing costs by informing you about the best payment systems and platforms for your needs. Stay tuned to the end of this video where I'll be giving you some bonus content which you will find useful if you're looking to use cryptocurrency payments in your business. Before I begin, I want to make it clear that I'm fully aware that CBDCs represent a huge risk to our freedoms. There are already lots of excellent videos on YouTube and elsewhere which explain how governments can use CBDCs to control and censor citizens. Therefore, I'll mainly discuss these issues at a high level in context of payments and how they impact businesses. With that said, here are the main areas I'll be discussing in this video. Firstly, I'm going to explain what cryptocurrencies are and what CBDCs are, and why they are relevant in today's world. I'll give some examples of each type of digital currency to make it easier to understand. Next, I'll discuss the similarities and differences between cryptocurrencies and CBDCs. And the differences are very important because governments and the mainstream media are pushing a certain narrative when it comes to digital currencies which can cause confusion. Lastly, by explaining the pros and cons of each currency, you will understand the opportunities and risks for consumers and businesses and the threats for all of us as citizens. A CBDC is a digital currency issued by a central bank, such as the Bank of England in the UK or the Federal Reserve in the USA. This is different to what we have today, where currencies are mainly issued by commercial banks such as Barclays or Lloyds Bank in the UK or Chase or Wells Fargo in the States. CBDCs can sometimes be referred to as digital fiat currencies or digital base money. A cryptocurrency, or a crypto as it's often referred to, is a digital currency designed to work as a medium exchange through a computer network that is not dependent on any central authority, such as a government or a bank. Bitcoin is the original decentralized cryptocurrency and is fully decentralized. This means that just like the cash in your wallet, you can hold Bitcoin in your own digital wallet that you control, i.e. your Bitcoin is not held in an account which is controlled by a bank or another party. It's important to note that since Bitcoin was launched, there are now many different types of cryptocurrencies in existence, some of which are even centralized, such as Ripple, or XRP as it's known by its ticker symbol. However, for the sake of simplicity, when I refer to cryptocurrency in this video, I'm referring to fully decentralized cryptocurrencies such as Bitcoin or Monero. There are many similarities between CBDCs and cryptocurrencies, and some of these include, first of all, being digital. Digital currencies offer huge advantages over cash and bank transfers in terms of speed and convenience. Digital currency transactions can often be settled in real time or near real time, which is a big benefit to businesses when it comes to improving cash flow. And cash flow is one of the reasons that B2B focused buy now pay later solutions have popped up from companies such as Tu and Biller AI in the last few years. Low transaction costs. Visa, MasterCard and Amex all charge around 2.8% on each transaction processed through their network. That is extremely high for businesses such as retail, where profit margins can often be as low as 1 to 3% on products such as groceries. CBDC or cryptocurrency transaction fees can often be as low as fractions of a cent. And both CBDCs and crypto are a massive threat to the business models of existing card providers such as Visa and MasterCard. Lastly, when it comes to cryptography, businesses and banks continue to experience ever-increasing levels of fraud and hacking attempts. Both CBDCs and cryptocurrencies ensure that digital payment transactions are as safe and as secure as possible, especially when it comes to large transactions involving thousands or millions of dollars. It will always be a game of cat and mouse, but both systems aim to make sure that the money of everyone involved is safe. Now let's move on to the differences between them. First one is centralization versus decentralization. Cryptocurrencies are issued and regulated by a network of independent computers, or peers as they are known, while CBDCs are controlled by a central bank. The benefit of a CBDC when it comes to payments is that transactions can be settled instantly, in real time, precisely because there is one single source of truth, being the central bank. On the other hand, Bitcoin transactions can take up to a few hours to settle because a network of computers must determine if a payment is genuine. If you want to understand more about this in detail, just search online for the Byzantine generals problem. As I mentioned earlier, there are many newer cryptocurrencies such as Ripple, which settle almost as quickly as CBDCs or in real time. However, cryptocurrencies such as Ripple are centralized because they were designed for a specific purpose. In this example, Ripple was designed primarily for international payments to be settled much more quickly than the current system, which is based on SWIFT. Ripple is great for businesses who trade internationally and need to pay suppliers or receive money from customers all over the world. Next, let's take a look at volatility versus stability. One of the main reasons that businesses have not adopted cryptocurrencies such as Bitcoin or Ethereum for payments is because their values are highly volatile. They are subject to high price fluctuations due to market forces and speculation, while CBDCs are pegged to the value of the underlying currency they represent, such as the US dollar or the Australian dollar. One of the key innovations to emerge from the cryptocurrency space to address this problem is stablecoins. Cryptocurrencies such as USDC or Tether were designed to simply be a digital dollar. So one USDC or one Tether is equivalent to one US dollar. Businesses found these to be useful for buying and selling goods internationally because there is basically zero price volatility. But the payments are ultra fast compared to using SWIFT and standard international bank transfer systems. Next, let's take a look at the difference between permission and permissionless. Cryptocurrencies can be accessed and used by anyone with an internet connection, whereas CBDCs may require special authorization or verification from the central bank or various financial institutions. This is especially important for businesses who are at risk of having their payments facilities shut down for political or religious reasons, as a few examples. If I focus in on a specific example, some gun stores in America have had their payment processing facilities or bank accounts shut down because a bank has decided that they do not want to be associated with that particular business activity. These businesses and their customers have not done anything illegal, but they have effectively been cancelled due to a certain narrative that is being pushed by the media, politicians, or pressure groups, as a few examples. Cryptocurrencies help businesses to avoid this problem by enabling payments to flow from customers who are abiding by the law. Central bank digital currencies, just like current payment systems, will allow businesses and institutions to determine what is and isn't acceptable in society, regardless of whether it's a perfectly legal activity. The next one is very important when it comes to anonymity versus identity. Cryptocurrencies allow users to transact without revealing their personal information, while central bank digital currencies can track and record user identities and all transactions. With CBDCs, governments would be able to instantly see what is happening in the economy if they could track every single payment. This could result in better public policy to manage the economy compared to today, where currently the government has to wait until the end of the month or the end of each quarter to understand what's happening in the economy. Today, governments can only manage the economy by looking in the rearview mirror, and central bank digital currencies could change that for the better. Businesses would also be able to benefit hugely if they could track who is behind every single payment. They could identify demographic trends, popular geographical areas, and many other factors which would give them the market intelligence they need to sell more products and services to their ideal customers. Governments argue that tracking central bank digital currency transactions is only necessary for regulatory purposes. However, it is dangerous to allow this level of access because CBDC transaction data could be used for political gain or coercion, as a few examples. In my personal view, the risks for abuse far outweigh the benefits for businesses and the economy as a whole. But that's simply my personal perspective. A prime example of this is how the Chinese government combines their digital currency with social credit scores to ensure that their citizens behave in accordance with what the government defines as acceptable behaviour. That's not the kind of society that I personally want to live in. I don't know about you, maybe you can comment below. It's also a myth that all cryptocurrencies are completely anonymous. Transactions carried out using Bitcoin or Ethereum can be tracked using several online tools, such as Etherscan, which allows you to track cryptocurrency transactions on the Ethereum blockchain. Using these tools, companies such as Chainalysis can investigate potential crimes committed with cryptocurrencies. In response to this, highly secure cryptocurrencies such as Monero have been developed to ensure that crypto transactions are completely anonymous. And these types of cryptocurrencies have their place if a business or a customer wants to keep certain information completely private, such as healthcare transactions as an example. Moving on to the pros and cons, both CBDCs and cryptocurrencies have advantages and disadvantages. In terms of advantages, both offer high-speed transactions, often in real time, lots of convenience, and low transaction fees. All of these benefits are great for increasing a business's cash flow, revenue, and profits. When it comes to disadvantages, both central bank digital currencies and cryptocurrencies have different disadvantages. So as a few examples, cryptocurrencies offer more privacy, but they're more difficult for consumers to manage in a decentralized wallet, because then they have to start managing things like their private keys, etc. And we all know what challenges that people have managing their existing usernames and passwords. But when it comes to your money, there's a certain level of comfort knowing that your bank is looking after your savings and bank account. CBDCs are highly scalable because each currency is managed by a single central bank. But newer cryptocurrencies such as Ripple and USDC lessen this advantage for the central bank in favor of businesses and consumers. Innovation can occur in the cryptocurrency space more quickly. This is because thanks to the internet, individuals all over the world can collaborate without the bureaucracy and bloat from out-of-date institutions such as central banks. Decentralized solutions such as NFTs and DeFi, or decentralized finance, were created without central authorities or institutions. Now, old-world financial institutions like central banks are playing catch-up. Lastly, there are certain things where both CBDCs and cryptocurrencies are on a level playing field. For example, when it comes to financial investment products, savings accounts, and transferring money overseas, both CBDCs and cryptocurrencies offer businesses and individuals the ability to manage their money in a way that suits them best. And I think that's the best way to summarize and conclude this video. Both CBDCs and cryptocurrencies have already rendered current payment systems to be obsolete. The old and antiquated payment systems that we have in place from commercial banks and the SWIFT international payment systems are no longer fit for the digitally connected world that we live in today. As long as businesses and consumers are aware of the implications of both types of digital currency, we will hopefully be able to live and transact in a world where everyone can pick and choose the best tools for their own individual needs. Now for the bonus content. If you want to learn about cryptocurrency payment systems that may be suitable for your business, I have interviewed some great guests on my podcast who offer crypto payment systems. 3 of the episodes I would highly recommend include episode 2 with Gilded, episode 12 with Hedera Hashgraph, and episode 16 with Dominic Frisby. To listen to them, simply open your web browser and type thepayments.show into the address bar and scroll down to the episodes I've just mentioned. Once again, the website address is thepayments.show. I've also provided the link to the episodes in the YouTube description box below. Thanks for watching the video. Please comment below if you have any questions, feedback, or other types of payment solutions that you'd like me to discuss on the channel. If you'd like to get in touch with me, head over to digitalmoneylab.com where you'll be able to send me a message. Thanks for listening and see you in the next video.